Hi, this is Optimus Futures, and we're here with our weekly roundup of key futures markets for our viewers. And we'll be starting off, as usual, with the S&P 500 E-mini futures market. So for this market, we didn't really witness a lot of major trading activity in terms of the market moving in one direction, either up or down, in a more decisive manner. And part of the reason here, we believe, could have to do with the market potentially gearing up for a pullback towards the breakout point of the wedge pattern that the market initially broke out of the week prior to last one. So if you recall our analysis from last week for this market, when the market was actually pretty bullish right at this point, we had identified the potential likelihood of the market stalling and trying to pull back towards this descending resistance trend line that forms part of the wedge pattern over here before we can see the market really take off again towards the north, or on the flip side just continue to consolidate for a more elongated sideways consolidation theme here. And that's pretty much what we're seeing here right now. Also, if we just stretch this the current price level further towards the left here, we can see that we had a very major swing high right around here that we are also possibly seeing the fake breakout of. So you can see that the market actually pushed past this former swing high over here, and then the bulls really weren't able to sustain that momentum at all. The market pulled back. It momentarily held as support at this former resistance area, but we haven't really seen a lot of major bullish activity come in that you would typically expect of a strong bullish move. So if this bullish move was to sustain itself, we would probably have looked for market action where the market had pulled back to this former resistance area, and the bulls had just basically taking the market further north from that point on, and in that scenario we would then probably contest for the market to potentially hit these more important former swing highs over here and possibly the 2800 round number as well. But we're not really seeing the developments here that would indicate to us that the market is going to continue to remain bullish, at least in the early part of this week. This lack of momentum from the bulls here could allow price to further trickle down and at least try to retest the area here that is marked by the initial breakout of the wedge pattern formation, as well as a more broader support and resistance area surrounded by these past instances when price basically bounced off of this 2675-ish horizontal support and resistance area. That's where we believe that the market here could be headed in the early part of the week, at least, if the bulls really aren't able to take price their way in the early part of this week. Okay, the next market we're going to be looking at here is the light crude oil futures market. This is another market that really didn't move much at all last week, like the S&P 500 E-mini futures market. And although we're still noticing here that the uptrend that we saw the market post after it broke out of the 66 major former resistance area just continues to be intact. We did see the market kind of create a new high over here, although we're not really seeing major bullish candlesticks here that we would typically like to see off of a strong move. Although we're still just confident that this uptrend here should likely continue, and our long-term targets for this market set at least a $75 price level just continues to stay in place. We continue to expect the 70 round number that runs right around here, and this immediate support and resistance area underneath the 70 round number here should continue to hold price up and provide for ample support for the market to continue to propel up north. Just to zoom out and reiterate the importance of the 75 round number here for this market as also a very, very important former support area that we expect the market to be headed towards to find some major resistance or at least a major holdup for this uptrend that we're seeing here. So that expectation here just continues to stay in place for us, and we expect this market to continue to move north following brief periods of consolidation and pullbacks that are really just typical of a strong up move anyway. Okay, so the next market we're going to be looking at here is the gold commodity futures market, which to us was one of the most interesting markets to follow last week. If you recall our analysis, some of the recent analysis that we've done for this market over the past several weeks, We've been talking a lot about the 1350 major resistance level for this market that has sort of formed the ceiling for this more recent consolidation that we've had for this market, and the floor marked by the 1300 round number right around here. That has also been really holding price up well, and in pretty much all of our weekly analysis for this market over the past several weeks, we've been talking about how our interest in this market would be revitalized as and when the market either breaks past the 1350 resistance level or breaks underneath the 1300 level. Well, we had a major development on that front over the last week. Of course, we had this very strong bearish candlestick that closed underneath the 1300 level and is starting to give us the initial indications of a breakout underneath the 1300 level. We're also noticing the next couple of days of activity that was really dull, and that really opens the forum for debate on at least two different perspectives. The first perspective that we're considering here is that as technical traders typically expect, the market, as it breaks out of important levels, traders usually expect the market to basically pull back to that region, test it as either support or resistance as the case may be, before continuing into the breakout direction, and that in this case would be further down. But on the other hand, if you've again been following our analysis for this market over the past several weeks, we've not really been talking about the 1300 level as a precise level. We've been talking about this level more as a zone, as a thickish zone identified by several price levels just above and below the main 1300 round number. So if you look at the market here holistically, you should be able to see that even though the market has obviously broken underneath the 1300 level, as well as this this consolidation phase here for sure, it's still sort of sitting at this former horizontal support and resistance area that is sort of in the middle of the thickish overall support and resistance that we're basically getting in the 1300 round number. So if you just look at the current price level that the market closed on Friday, it's still sort of sitting at all of these major former resistance areas where price bounced off of. So even though the market has closed underneath the 1300 level, we would definitely be looking forward to some more bearish activity here before really claiming that the market has for sure broken out of the 1300 round number and this thickish support and resistance area over here, which should then really ignite our interest in possibly seeing a more sustained move towards the downside for this market. Because as we see this market right now, we expect the market to potentially pull back, either to test this this former area over here as resistance and continue its way down, or we could even see a full-blown rebound off of this area over here and basically create a more of a fake breakout scenario of a 1300 round number as well. Because like we said, the market certainly hasn't cleared the more thickish horizontal support and resistance areas surrounding the 1300 round number here that really could trigger for some strong buying to come in early this week. So even though we're optimistic about a possible sustained move towards the downside here, just looking at how the market has quite certainly pushed past the 1300 round number here, we will definitely be looking for some more bearish activity in the early part of this week to get really excited about the market finally breaking underneath the 1300 horizontal support and resistance area and the close by regions. Okay, so the next market we're going to be analyzing here is the euro currency futures market, which against all odds just continues to push down and make some major strides towards the downside. So for this market, we had identified this period of consolidation towards the left, and all of these major support and resistance levels created as a result of that consolidation in the past that we believed could play a role in creating some kind of obstacles for the sellers as the market tries to push down and penetrate past all of these important areas over here. We did sort of see that in the week prior to the last one, when the market sort of rebounded off of this this major support and resistance level from the past over here. but it really just turned out to be a pullback towards the 1.2 major round number, where the sellers once again were able to take control of the market. And since then, we've really just seen the sellers dominate pretty much for the entire last week. So even though we're seeing some very dominating sell side price action over here, our initial analysis for this market continues to hold, which is that we expect the market to find trouble at all these very noticeable former support and resistance areas. And even though the current momentum here could easily allow price to push past these past levels like these, we really wouldn't be surprised to see the market stall or rebound at this level. Although if the sell side momentum really continues, we could see the market actually pushing right past this level over here and possibly hit this more important swing low right around here, possibly towards the end of this week or maybe even next week, if like we said, if this sell side momentum really just continues and the market continues to push past all of these former horizontal support and resistance areas as it has been doing it so far. Okay, so the next market we're going to be analyzing here is the 10-year Treasury note futures market, which to us is showing all the indications that we need for a sustained and solid downtrend in place. So we're continuing to see the market basically push past former swing lows and former areas of support, use them as resistance, and just continue to push forward. We saw that happen last week as well, as the market basically pushed past this former important, well, not very important, but a minor swing low over here, and basically create a new weekly low. And we're now basically seeing the market pull back again, and ideally we should now expect the market to continue to find resistance at this former support area and just continue its way down. So even though we pretty much have the foundations here that we need to expect more sell side activity to come in for the market, that scenario sort of changes as we zoom out of the chart here to look at a more longer term perspective, which paints a slightly different picture. So as we zoom out here, we can see that the market, where it stands right now, is actually perilously close to a very important time back when the market was at current price levels in 2011. So you can see that we had a very, very strong bounce created off of this area here, a longer term bounce, and we have some very important swing lows right around at current price levels that really could allow for history to potentially repeat itself here. So even though we're looking at all the signs that we need to expect some more sell side activity to come into the market and for the bearish trend to be intact, we're also looking at these more longer term levels here, basically surrounded by the 118 big round number right around here. And even though the market really hasn't tested the 118 round number just yet, that really will be a very key price level for this market in our view, because it really just lines up with all of these very significant and crucial long-term swing lows that we last saw the market bounce very, very hardly off of. So while we do expect the market to possibly just continue its way down, the 118 level is where we believe we could see some fireworks in terms of the market actually trying to rebound, or possibly even try to consolidate or build some more momentum towards the downside.